A slew of analyst initiations on Circle today, as mostly are bullish, but many raising some concerns over its valuation. Remember, it's up 500% from its IPO earlier this month. But my next guest is in the bull camp. He initiated with a $230 price target. It's $50 higher from here. Says it's a must-hold for investors. Let's bring in Bernstein's Gautam Chhugani. I don't know, Gautam, if you caught that Vlad Tenev interview we just had either, because it all kind of goes back to the future of the crypto ecosystem. Welcome.
Yeah, thanks for having me.
So tell me why you think it's such an essential hold to invest in stable coins.
Yeah, so stable coins are digital dollars on the internet. We see digital dollars, which so far have been a money rail for crypto. We see that becoming a money rail for, in general, internet, which means it has implications for what happens to broader payments and financial services. So we see stable coins going from about $225 billion today to $4 trillion over the next decade. We've done a bottom-up industry sizing based on use case, kind of around crypto, tokenized capital markets, payments, and financial services. Circle is once the Genius Act is passed, would be the largest regulated stablecoin. That gives it a solid regulatory edge. And given its sort of $61 billion of liquidity, we think it has a massive head start versus new stablecoin competitors in the space. So we see that as, the only exposure which kind of gives you asymmetric upside to this wide market.
So, but can you tell me by analogy how Circle makes money, or directly? In other words, I keep going back to stablecoins and thinking about money market funds from, pre-financial crisis. Point being, investors want $1 that gives them a little bit more than $1. And in order to give a little bit more than $1, there's usually some corporate paper, high yield, short-term instruments, maybe a little bit of leverage involved. That ultimately became very risky in that case back in the day when they broke the buck. How similar or not is that to the way that stablecoins work now and what you as an investor are getting?
Yeah, so I think what you described was the sort of heady days of 2021. We've come a long way in the crypto industry. The Genius Act defines stablecoins as a payment stablecoin, and then it kind of goes on to define how stablecoins are 1:1 pegged to the dollar and 100% backed by mostly demand deposits, bank deposits, repos, and U.S. Treasury. So it's super liquid instruments. This will never break the dollar, as you would have sort of observed in the past. And then Circle makes money because it holds the yield against those stablecoin collateral, and then enables this infrastructure for the wide ecosystem, which sort of allows everyone to kind of use this dollar for broad use cases around payments and financial services.
Right, but if the stablecoin now, because of the regulation, whatever, has to basically be backed by U.S. Treasuries, then aren't their profits somewhat capped? I mean, how much upside can there really be if all that they can hold is treasuries?
Yeah, so I think there are two big revenue lines. One is obviously float income. So to that extent, this is driven by what the rate environment will do. So right now, obviously, they make more than 4%. As obviously the rates go down, they sort of their revenue obviously goes in line with that. But they're also kind of enabling this infrastructure around blockchain, financial services, the Circle Payments Network that they've launched, which allows them to start to earn a fee income as well. Now, that will take time over the next 5 to 10 years, but going forward, obviously, what matters is how do they sort of balance this between the float income and the payments transaction-based income. But I think the more important thing here is that today, stable coins are at $225 billion. So I think what's going to offset this, in case there's a rate decline, is the total volume, the total demand that we see. So I think our conviction comes from the total demand from stable coins, driven by the use cases and the bottom-up industry demand that we're talking about.
Sure.
So I think eventually you need to see it more holistically, versus, where the rates are going, but also the total demand that's likely to come.